Welcome to This Explainer. We are jumping right into a financial shift today that is quietly, but massively, rewiring the entire global economy. We're going to dive into a totally fascinating and, frankly, kind of terrifying paradox. We're looking at why the absolute safest investments in America might suddenly be the biggest threat to everything else in your portfolio.
Okay, so let's start by looking at just a single number, 5%. I know it sounds tiny, right? But in the financial world, this number is currently sending absolute chills down investors' spines. You see, for the first time since the great financial crisis back in 2007, bond yields have pushed above this 5% mark. And that single digit, it's acting like this massive gravitational pull. It's dragging down stock markets, it's pushing up mortgage rates, and it's basically forcing everyone to rethink their entire financial strategy from the ground up.
This really matters because it marks the end of an era. For the last 15 years, our entire economy was essentially built on the concept of cheap money. I mean, homes skyrocketed in value because you could borrow huge amounts for practically nothing. Stocks went higher because, let's be honest, there was literally nowhere else to get a decent return on your cash. But right now, we are watching that entire system rapidly reverse in real time. The era of free money is officially over. So, to grasp what this all means for you, here is our agenda. First, we'll decode the bond market. Then we'll look at the three forces pushing yields, check out some echoes of past crises, break down four major economic warning signs, and finally wrap up with the Fed's impossible dilemma. All right, part one, decoding the bond market and looking at the inverse relationship. Before we get to the crisis part, let's just make sure we're all on the same page about how government borrowing actually works. When the United States needs cash, which, is basically always, it issues Treasury bonds. It's just a simple loan. You lend the government your money today, they promise to pay you a fixed, consistent interest rate over a set time, and at the end of that term, you get your original investment back. And since the US government has historically never defaulted, it's considered a totally risk-free place to park money. Pension funds, banks, they absolutely eat these things up. But here's the crucial mechanic, and this is what trips people up all the time. Bond prices and bond yields move in opposite directions. It's exactly like a seesaw. Imagine you buy a bond for $100 and it pays out $5 in profit. That's a 5% yield. Now, what if investors panic and start dumping that government debt? Demand plummets, and suddenly they're only willing to pay $80 for that exact same bond. But remember, the bond still pays that fixed $5 profit. Well, making $5 on an $80 investment, that suddenly equals a much higher 6.25% return. So when you see the news screaming about yield spiking, it just means a ton of people are selling off government debt and demanding a way higher return to lend out their money. Moving to part two, the three forces pushing yields, the accelerants. So why are investors suddenly demanding higher returns to lend to the safest borrower in the world? Well, it's because we've got three massive macroeconomic forces slamming into the market all at once. First, inflation is rebounding. Recent data showed the consumer price index jumping 3.8% year over year. And the producer price index, which is the wholesale inflation that businesses pay, shot up 6%. Second, oil prices are spiking. With the conflicts in the Middle East threatening supply chains, oil has blasted past $100 a barrel. And since oil touches everything from shipping to food production, higher oil basically guarantees higher inflation down the road. And finally, force number three, the government is completely flooding the market with new debt. Just to put the sheer scale of that debt into perspective, $2 trillion. The United States is currently running roughly a $2 trillion annual deficit. We're spending so much more than we bring in. To cover that massive gap, the Treasury constantly has to issue this flood of new bonds. But here's the kicker. Major foreign buyers, like Japan, who by the way holds over $1.2 trillion in U.S. debt, they're pulling back because their own domestic yields are going up. So you've got this insane surge in the supply of U.S. bonds and a drop in international demand. The only possible way to attract buyers, you have to raise the yield. Let's look at part three, echoes of past crises, specifically 1994 and 2023. To really get why a rapid rise in yields is so dangerous, history gives us a pretty stark warning. Take a look at these two specific moments where the bond market basically broke. First, the 1994 Great Bond Disaster. Things felt totally fine, yields were low, and then the Fed rapidly hiked rates. The 30-year Treasury spiked from under 6% to over 8% in just months. Mortgage rates shot up 30%, and bond investors lost a staggering $1 trillion. Fast forward to the 2023 banking crisis. The 10-year Treasury briefly passed 5% purely on inflation fears. That sudden spike left banks holding the bag with huge unrealized losses on their older, lower-rate bonds. The broader stock market fell 10%, and some banking stocks literally plummeted by 50%. Both of those events prove that when yields spike rapidly, immense value is wiped out, and real-world systems just shatter. But here is why today is different. Historically, whenever yields touched 5%, things broke, the market stabilized, and rates eventually dropped back down. 5% was the ceiling. But today, with our massive deficits and this super sticky inflation, there is a very legitimate fear among investors that 5% isn't the ceiling anymore. It's the new minimum. It's the floor. And that brings us to part 4. 4 economic warning signs, the shockwaves. Because if 5% really is the new floor for borrowing, it triggers a brutal chain reaction. Warning sign number 1 is the government debt spiral. It works exactly like getting trapped in credit card debt. As bond yields rise, the US government, which already pays over $1 trillion a year in interest, by the way, has to spend tens of billions more just to service that debt. That wider deficit means they literally have to borrow more money just to pay the interest on the old money they already borrowed, which floods the market with even more bonds, pushing yields even higher, and the whole vicious cycle just feeds itself. But those shockwaves definitely don't stop at the government level. Sign number 2, stocks face massive downward pressure. Think about it. Why would you risk your hard-earned cash in a super volatile stock market hoping for a 7% return when the government guarantees you a totally risk-free 5% to just sit there and do nothing? Sign number 3, the housing market freezes solid. Anyone sitting on a 3% mortgage from a couple of years ago is wearing golden handcuffs. There is no way they're selling their house if it means taking on a new mortgage at 7%. It absolutely kills housing inventory. And sign number 4, corporate America grinds to a halt. As borrowing gets more expensive, companies can't afford to expand, hiring freezes up, and earnings compress. It's like this slow, creeping constriction of the entire economy. Finally, part 5, the Fed's impossible dilemma, the ultimate catch-22. All of this pressure leads us straight to the climax of this whole situation. What on earth does the Federal Reserve do next? They're the ones supposed to manage this chaos. But right now, they are staring down the barrel of a true catch-22. Neither of their options ends without some serious pain. Just look at the choices here. Option A, the Fed steps in, lowers interest rates, and provides some relief to the markets. Sounds good, right? Well, the danger is, if they do this too soon, before inflation is truly dead, inflation comes roaring back even stronger, which pushes yields right back up anyway. Okay, option B, they keep rates high for longer to really fight that inflation. The danger there, those high rates slowly crush the housing market, they kill corporate growth, and they absolutely explode the national debt with those massive interest payments we talked about earlier. They are walking a razor-thin tightrope right now. So what does this all mean for us? Well, the most practical takeaway here is to play defense through flexibility. Right now is not the time to take on excessive debt or high leverage. You have to understand that while a 5% yield looks awesome, long-term bonds carry massive short-term volatility risks if rates keep climbing. And crucially, don't panic sell your long-term stock investments just because of short-term fear. Historically, peak panic is exactly when the markets start to price in a solution. As we wrap up this explainer, I want to leave you with a question that really should guide your financial planning for the next decade. If the data is right, and 5% is the new floor rather than just a temporary ceiling, if the era of cheap, easy money has officially vanished, is your portfolio prepared for the reality of tomorrow? Or is it still hoping for the economy of yesterday? Think about that. Thank you so much for exploring this totally fascinating topic with me today. Keep learning, stay curious, and I'll see you in the next explainer.